Whenever money is invested or lent, a return is expected. This return is called an interest rate. But an interest rate is not just a random number. It is built step by step to compensate the investor for time, inflation, and different types of risk. In this video, we will start from the very beginning, understanding what an interest rate represents, and then break it into its individual components with clear and relevant examples. What is an interest rate? An interest rate is the required rate of return that an investor demands for giving up the use of money today. From the investor's point of view, it is a return. From the borrower's point of view, it is a cost. Interest exists because money today is not the same as money in the future. Example, if you lend rupees 10,000 today and receive the same 10,000 after 1 year, you gain nothing for waiting. Because you waited 1 year, you expect more than rupees 10,000. That extra amount demanded is reflected in the interest rate. Why interest rates are different? All investments do not carry the same conditions. Some investments are very safe, some are risky. Some are easy to sell and some are difficult. Some are short term and some are long term. Because these factors differ, the interest rate demanded by investors also differs. To understand these differences, we break an interest rate into components. An interest rate can be thought of as a basic return for waiting plus additional returns for inflation and risk. This helps us understand why one investment offers 6% and other offers 10%. Now let us understand each component clearly. The real risk-free rate is the return required only for postponing consumption. It assumes two big things. There is no inflation and there is no risk of default. Even in a perfect stable economy, people prefer money today rather than money in the future. Example, suppose you have rupees 50,000 today. You can use it immediately for consumption or investment. If someone asks you to give up this 50,000 rupees today and take it back after 1 year, you will expect something extra in return. That extra in return is compensation for waiting. This waiting cost is also called as opportunity cost of money. The return that compensates only for waiting with no inflation and no risk is the real risk-free rate. In reality, prices increase over time. When price rise, money loses purchasing power. Investors do not want their future money to buy fewer goods than today. Therefore, they demand additional return to compensate for inflation. This additional return is called the inflation premium. Suppose rupees 100 today can buy 10 units of a product. If price rises by 5%, rupees 100 next year will only buy you about 9.5 units. To avoid this loss, investor demands at least 5% extra return. This ensures their purchasing power is protected. Normal risk-free rate. When we add real risk-free rate plus inflation premium, we get the normal risk-free rate. This is the return demanded when there is inflation but no risk. Example, if the real risk-free rate is 2%, expected inflation is 4%, then normal risk-free rate is equal to 2 plus 4, 6%. This 6% return keeps purchasing power intact and provides a real return. Default risk premium. Not all borrowers repay their obligations. Some may fail to pay completely. This uncertainty is called default risk. To compensate for this risk, investors demand a default risk premium. For example, lending money to a government with strong finances is safer than lending to a weak company. Because the company may default, investors demand higher interest. That extra interest is the default risk premium. The next one would be liquidity risk premium. Liquidity refers to how easily an investment can be converted into cash without loss of value. Some investments can be sold quickly, some cannot. If an investment is difficult to sell, investors demand compensation. This compensation is called liquidity risk premium. Example, shares of a large listed company can be sold easily in the market. A private investment may take months to sell. Because cash access is uncertain, investors demand a higher return for illiquid investments. Next one would be maturity risk premium. Long-term investments are exposed to more uncertainty than short-term ones. Interest rates may change, inflation may change, economic conditions may change. Because of these, investors demand a maturity risk premium for holding funds over longer periods. Example: a 1 year investment has less uncertainty than a 10-year investment. The longer the time period, the greater the uncertainty. Therefore, longer investments generally offer higher returns. Now we discuss complete interest rate structure. The required interest rate is the sum of real risk-free rate, inflation premium, default risk, liquidity risk premium, maturity risk premium. Each component compensates for a specific sector. If you look at the numerical example, if real risk-free rate is equal to 2%, expected inflation is equal to 3%, default risk premium is equal to 1%, liquidity risk premium is equal to 0.5%, and maturity risk premium is equal to 5%. Then required interest rate would be 2 plus 3 plus 1 plus 0.5 is equal to 7%. This 7% return fully compensates the investor for time, inflation, and risk. In summary, interest rates are structured numbers. They are not guessed, they are built. Understanding each components help in valuation, comparison, and intelligent investment decisions. If you think this video is helpful, please like, share, and subscribe to my channel. Thank you.